Hello and welcome to AI Market News by LM. A truly shocking event at the White House Correspondents' Dinner has just sent a massive jolt of uncertainty through the markets. So today, we're going to break down how this one single event is connected to everything from global oil prices to what central banks are going to do next, and even the fate of big tech's earnings this week.
So first things first, let's really unpack what actually happened at this high-profile dinner. I mean, just listen to that. That quote really captures the absolute chaos of the moment. Gunfire erupts, the president is rushed from the stage, and just like that, an immediate wave of instability washes over the nation's capital.
Okay, so here are the key details. We have a clear, major security breach, and while it's a huge relief the president was unharmed, an incident like this, it injects a level of political risk that markets have to price in, and they have to do it fast.
Right, so this is so much more than just a security incident, isn't it? It's really a powerful symbol of just how unpredictable risk can be. So the huge question for all of us is, how does this instability actually translate to our portfolios and the wider economy?
Well, this domestic shock doesn't happen in a vacuum. Not at all. It actually amplifies global tensions that are already simmering. And right now, there's nowhere on Earth where that tension is higher than in the world's most critical oil choke point. And here it is, the blockade of the Strait of Hormuz. It's already being called the biggest supply shock in history. Now, to put that in perspective, we're talking about almost a fifth of the entire world's daily oil supply just choked off. Reports are saying 1 billion barrels are already offline. It's a massive deal, and this is what's creating a really high-stakes standoff. As we can see from the opposing positions here, neither side is even close to backing down. And what that means for the markets is that any stray headline, any rumor, could cause absolutely wild swings in energy prices, which of course feeds directly into global inflation numbers. So we have political shocks at home, and we've got energy shocks coming from abroad. So how in the world are central banks supposed to respond to all this? Well, they're being forced to walk a very, very dangerous tightrope. And if we look at the schedule, the response is pretty much unanimous. Just wait and see. All the major G7 central banks are expected to hold rates steady this week. They're essentially frozen, trying to navigate these twin threats of skyrocketing inflation on one side and a potential recession on the other. And the market is absolutely getting the message. Based on data from the FedWatch tool, the probability of a rate cut anytime soon has just plummeted. In fact, futures markets are now pricing in a greater than 90% chance that the Fed will be forced to keep rates higher for longer just to fight this new wave of uncertainty. So, with governments and central banks kind of stuck in a holding pattern, all eyes are now turning to the corporate world. And more specifically, the question is, can the market's biggest companies, the real giants, withstand all this chaos? And as this chart here shows, the market's largest companies, what we all call the Magnificent Seven, they've rebounded and rebounded sharply, right before they're set to report their earnings. You know, their performance this week could either justify this whole rally, or it could signal some major trouble ahead. And this bar chart really shows exactly why the stakes are so incredibly high. With the combined market caps somewhere around $16 trillion, these few companies are expected to dramatically outpace the rest of the S&P 500. And what's fueling it? For the most part, it's the ongoing AI investment boom. Okay, so we've got all these conflicting signals flying around, right? Geopolitical fear on one side, but this incredible corporate optimism on the other. So how can we actually measure the overall emotional state of the market right now? For that, we can turn to a really neat tool called the CNN Fear and Greed Index. It's basically designed to give us a simple, data-driven snapshot of whether investors are feeling, well, fearful or greedy. And what it's telling us right now is pretty fascinating. Despite all the negative headlines we've been talking about, sentiment has just flipped positive for the first time since this whole Iran conflict began. And that suggests that for now, at least, greed and optimism are actually winning out over fear. So how does the index figure this out? Well, it looks at 7 key indicators, and these range from really technical things like stock price strength and market momentum, all the way to behavioral clues, like whether investors are piling into risky junk bonds or are they fleeing to the safety of government bonds. Okay, so let's bring this all together and take a look at the week ahead. What are the key events that are really going to decide whether that fear or that greed wins out? If we look at the economic calendar from investing.com, we can see this week is just absolutely packed. We've got major policy decisions from the Bank of Japan, the Fed, and the ECB, all happening alongside those critical can't-mess earnings reports from Microsoft, Alphabet, Amazon, and Meta. It's going to be a wild ride.
And all of this leaves us with one final and I think crucial question. In a market that is so chaotic and so driven by headlines, is the bigger risk ignoring the data, or is it believing the data too much? That's the tightrope we are all walking this week. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching, and if you found this breakdown useful, don't forget to like and subscribe.